Hello, my dear students. Let's add value to your knowledge account today. I'm Dr. Bharati Sunil. Have you ever wondered why business maintain accounts? Is it just to calculate profit? Actually, accounting serves many important purposes that go far beyond its numbers. In this video, let's understand the main objectives of accounting and why they are crucial for every business, whether the business is big or small. Let's get started. Today we'll discuss about objectives, advantages, disadvantages of accounting and branches of accounting. Objectives of accounting. A business is a going concern. So whatever the financial statements a company is preparing, that should be permanent in nature. So they will be providing that in a permanent form. And all the business transactions, whatever they are entering into their books of accounts, that must be accurate. And no guest figures are to be provided. And the information, whatever we are providing, that should be complete in nature. Second, calculation of results of operations. When any business is done, the business wants to know what is their operational result. For this purpose, business prepares trading account, profit and loss account. This will help the business to know whether the business is making profit or losses. Next, ascertaining financial position. How this can be happen when the company prepares balance sheet. In that balance sheet, the company can know what are their assets, liabilities, and what is their capital on a particular date. And why all these accounts are prepared to communicate that information to various stakeholders. Who are stakeholders? Who are having connectivity with the business. Stakeholders can be creditors, employees, bankers, customers, suppliers, shareholders, etc. And why these financial accounts are prepared to review and revise business policies by comparing present and past financial statements. After preparing financial statements, business will review all those statements, and based on that, the company will revise its business policies. Here I gave objectives of financial accounting. This will be very helpful for your understanding because I gave this in the diagram form. You can remember very easily. First one is complaints with statutory requirements. So when any business you can take as example, here I would like to quote about Tata Steel. Tata Steel prepares its financial statements according to Companies Act 2030 and Indian accounting standards. Why the complaints is necessary? Because the company can avoid penalties and also to maintain their listed status in stock exchange. Coming to the second one, safeguarding the interest of various stakeholders. Who are stakeholders who are having connectivity with the business? They can be owners of the business, managers of the business, employees of the business, customers, suppliers, bankers, creditors, government, income tax authorities, community, etc. Here we can take the example of a mutual fund company. Mutual fund company provides detailed reports about their company's performance, and these performance reports will be definitely helping investors to know whether their funds are properly invested by the mutual fund company or not. Third one, helps in the measurement of profit and loss of business. For instance, Reliance Retail, based on their quarterly reports, can analyze their store locations in India, which store locations are performing well and which are need to be improved. Fourth one, presentation of historical records. HDFC Bank is maintaining its financial records for the past 10 years to show consistent growth pattern when they are applying for international expansion. Fifth one is focus on external transaction of business. IT service company wants to know external transactions of business like their client billing and vendor payments or tax obligations of the company, excluding internal information regarding department transfers, etc. Sixth one, periodic reporting, and wide availability. Infosys is publishing its financial reports on website for maintaining transparency of its business. Basis for other accounting. Manufacturing companies use financial accounting data to prepare cost accounts. This will be helping them to track their production efficiency, meeting the objectives of various stakeholders. A pharmaceutical company is preparing its financial statements by taking into consideration the various interests of stakeholders. If you take the example of investors, investors require financial statements for the purpose of their profitability. Employees required for their growth aspects. Liquidity is required for creditors, and compliance is required for government. By taking all these aspects into consideration, financial statements are prepared by a pharmaceutical company. Next, only financial transactions. If you take any business, only financial transactions will be entered in books. A software company purchased a server equipment worth 50 lakhs. This is recorded in books of accounts. But the same software company will not consider the technical expertise that is spent for configuration because this is non-financial information. Next, reliability and relevance. A pharmaceutical company preparing its financial statements highlight R&D investments and clinical trial success rates side of their traditional metrics. Investors specifically trust these audited figures to evaluate both current financial health and future growth potential based on the drug development pipeline. So this shows how reliable financial information, that is audited figures, that provides relevant insights which directly connect stakeholders to make decisions in that specific industry context. 11th one, easy to understand. Maruti Suzuki provides financial reports with clear charts and explanations that allows the non-financial stakeholders also to grasp the company's financial health and its major trends. This is about objectives of financial accounting. Next topic is advantages of financial accounting. Coming to the first advantage, standardized reporting. All the companies have to follow Companies Act 2013 and Indian accounting standards. Every company has to follow the same accounting procedures. So this will enable the company to make comparison with its previous performance or to compare with the related business in the existing business world. Second one, audited financial statements brings credibility with stakeholders. Stakeholders who are dealing with the company, by checking audited financial statements, they can have complete confidence on the business. Example, bankers will consider financial statements when they have to sanction any loans to the business. Business performance evaluation. A business performance can be evaluated only through financial accounts. Income statements will enable us to know what is the profitability of the company, and balance sheet will enable us to know what is the financial position of the company. And financial accounting will definitely help investors to take investment decisions based on their financial statements. Investors will come forward to make investments if the company is making good progress. Legal complaints. Claims against a business, whether it is by its creditors or claims by the business against its debtors, can be established only by when it is proved by the court of law. So for this, business has to produce its financial statements as evidence. Historical record. All the books of accounts, whatever we are preparing, are based on its past performance of the company. Capital attraction. A company can attract investors only when it is having good financial position. A business can attract investors or bankers only through its perfect financial statements. If the company is creating confidence to them, definitely investors or bankers will come forward to invest funds or to provide loans to the company. What are the disadvantages of financial accounting? What is financial accounting? It only records all the past information. The past information cannot change the present, what is happening in the business. Whatever the information that is provided in financial accounting is like postmortem. But when management want to take decisions, frequent information is to be provided at regular intervals so that management can take appropriate decisions. It ignores non-monetary information. In financial accounting, only monetary information is considered, and non-monetary information like efficiency of business, employees' loyalty, customer satisfaction, technical advancement in the company are not considered in financial accounting. But that is also very crucial for management to take any decision. Preparation costs. A small business requires significant resources to prepare financial accounting. So, small businesses generally cannot afford to have complete financial accounting procedures. Complexity barrier. Financial accounting cannot be easily understood by non-financial stakeholders. That means who are not having adequate financial knowledge. Inflexibility. There are some standardized rules like GAAP or IFRS, which may not allow for unique needs of a business because we can find different types of business. All businesses are not same. So when we are adapting this GAAP or IFRS, we find difficult to incorporate in our accounting. It cannot reveal efficiency of business. If a business is getting losses, that can be because of external factors like recession or war, but that cannot be shown in financial accounting. So we cannot judge a company's performance just only with financial accounting. Coming to the next topic, types of accounting. There are three branches of accounting. The first one is financial accounting, second one is cost accounting, third one is management accounting. First one is financial accounting. Why financial accounting is prepared? For example, a construction company is preparing financial statements. It is producing its annual statements for bank loan approval to show their stable financial position to the banker. Second one is cost accounting. A clothing manufacturer is tracking the exact cost of producing each garment. For example, to produce any garment, we require fabric, labor, electricity. So, for all these three things, how much is his cost? He wants to know that. So, for this purpose, he is preparing cost accounting. So, this will enable him to set a appropriate price for his clothing business. Third one is management accounting. If you take the example of hospital, a hospital administrator, he uses financial reports to decide which department need additional staffing or which department is requiring how much of budget. So for additional staffing or budget adjustments, management accounting is prepared. Now we'll go into depth. What is the purpose of preparing financial accounting, cost accounting, or management accounting, and who are the audience? The purpose of preparing financial accounting is to know the financial position of a business. And who wants to know this financial position? Like investors and banks. Coming to cost accounting. What's the purpose of preparing cost accounting? To track costs for its internal use in production. When a business is producing any products, they want to know how much of cost is incurring in their production. For that purpose, cost accounting is prepared. Coming to the third one, management accounting. Management accounting helps managers to plan, decide, and control. For performing their management functions, management accounting is required. Time orientation. Financial accounting is based on past. It looks at past performance. Cost accounting is present. It looks at past and current costs. So cost accounting is required to know presently what is the cost that we are incurring in our production. Management accounting. It is future oriented. We look ahead to future planning in this management accounting. Regulations. In financial accounting, we are having strict rules like GAAP, IFRS. In cost accounting, there are only some rules which are very much flexible. And coming to management accounting, there are no formal rules. It is completely specific based on the company. Reporting and frequency. We need to prepare financial statements quarterly or annually based on the type of business and size of business. But cost accounting is prepared whenever needed for production. And management accounting, either monthly or whenever management is requiring accounts, they will prepare management accounts. Level of detail. Whole company summaries to be prepared in financial accounting means it should cover all the branches or all the products while preparing financial accounting. Cost accounting, it is only based on the product or services. Management accounting, it is based on teams, it is based on products or regions. Key reports. What are the reports that are covered under financial accounting? Balance sheet, income statement, cash flow statement. In cost accounting, we prepare cost sheets and variance reports. In management accounting, we prepare budgets. Budgets can be flexible budget or fixed budget. We can also prepare master budget, sales budget, cash budget. Next, break-even analysis also we do. What is break-even analysis? Here we'll prepare PV ratio, margin of safety, BEP, etc. Next, we'll also prepare key performance indicators in management accounting, that is KPIs. Next, users of financial accounting. Users of financial accounting are divided into two. First one is internal stakeholders. Who are internal stakeholders? Internal stakeholders are individuals or groups within the organization and who are directly involved in company's operations and affected by its performance and decisions. Internal stakeholders means owners, shareholders, because they have invested their money in the business. Because when they have invested money, they want to know what is their return on investment or their profits in the business growth. Next to management. Management includes CEOs, department heads, and managers who are involved in planning, organizing, and decision making. They use all the accounting information to take strategic decisions. Next, employees and staff. Employees and staff are working for the business and they are depending upon their income. So they want job security and they also want good working conditions and different benefits for their growth. Next, coming to the fourth one, board of directors. Who are board of directors? Who are elected by shareholders to oversee the company's performance. They use financial reports for governance and accountability. So internal stakeholders are people inside the organization who actively contribute to its daily functions and depend on its success. Next, coming to external stakeholders. Who are external stakeholders? They are individuals or groups outside the organization who do not work within the business but are affected by its activities or they have some interest in the performance of the company. Example, customers. Customers, they buy companies' products or services because they are interested in the quality, price, and service of the company. So they also interested, they show interest in financial accounting. Next, suppliers. Suppliers provide raw materials to the business or services to the business. So they are interested in timely payments by the company and they want to have long-term relationships with the business. So for that purpose, they require financial accounting. Next, creditors or bankers. Creditors or bankers, they provide loans or they provide some credit to business. So they want to know whether the company is having the repayment capacity or not. That is why they require financial accounting. Next, government and regulatory bodies. They want to ensure that the business should follow all the laws that are framed by the government, whether it is relating to taxation or labor environment. So that is why they are interested in financial accounting, to know whether they are having the legal complaints and whether they are prompt in making tax payments. Next, investors. Investors means who are potential, means who can invest in future. They want to know about the company before investing in the company. They want to know financial health and financial growth of the company. So they can know only through financial accounting. Next, public and society. General public can also get affected by a company's environmental and social impact. They want to know whether the company is having ethical practices or the company is also doing corporate social responsibility. For this purpose, even general public and society also want to know about financial accounting. Next, competitors. They are not directly involved in the company, but they observe what the company's market actions and company's performance. Finally, external stakeholders are people or entities outside the organization who are influenced by or who are having interest in its performance, in its decisions or outcomes of business. So that is why financial accounting is required for both internal stakeholders and external stakeholders. This is about today's video. Today we have covered objectives of financial accounting, advantages and disadvantages of financial accounting, branches of accounting, and uses of financial accounting. That's all for today, but learning never stops. Thanks for watching. Please like, comment, share, and subscribe. We'll meet in the next video. Thank you.